In this week's update, the path of least resistance for US stocks remains upwards. The US dollar, a key driver for equities, and precious metals, holding its breakout despite weakness on Friday. My name is Garry Davis, and as always, this is general advice. And please remember to like and subscribe to the video. Okay, let's start with some overall market perspective, as we do every week. And inflation is really the main risk that the market continues to be focused on, and probably rightly so. And I did read an expression a couple of days ago, which I thought was very appropriate, and that is about inflation being persistently transient, because it seems like this inflation debate has been going strong now for quite some time, pretty much all this year. And in varying forms, people have been talking about inflation becoming a problem since really not about 2010, when the massive stimulus really started. Everyone was expecting 6 or 7 or 8 years ago that inflation would be a problem, and it has never really emerged. And if you look at Japan as an example, which has been trying to generate inflation for more than 2 decades now and has been spectacularly unsuccessful, then it just shows again that there's not necessarily a direct link between what is logical. It's logical to think that if you've got an economy that's running well and you just keep shoveling more money on top of it, like putting more fuel on the fire, that inflation will start to pick up. That's logical. But there are other factors at play that have been holding inflation in check. But there's certainly signs now that we haven't seen in the past decade. And I think it's safe to say that inflation is now more likely to be real, but to what degree still needs to be determined. So for me, we need to not focus on what the media and the commentators are saying, because that's just pursuing a logical argument and is often wrong. So we need to watch what the bond market is saying, and at the moment, the bond market yields are still in around the 1.5% for the 10-year yield, and it hasn't moved for quite some time. So the bond market is not concerned. And they're generally much smarter operators than the equities market. And of course, we can't trust what the Fed says really, because they're just running a particular line which is probably part political, and they're often in the market either trying to talk it up or talk it down. So I don't go too much on what the Fed actually says. A couple of things that are a little unusual, to say the least. The sector leadership at the moment, technology, is going really strongly, new all-time highs. And that's surprising, because normally if inflation, and we did see quite a strong inflation number in the US in the last week of about 6.2% for October, and normally that would see tech stocks starting to cool off. But tech stocks are still marching ahead very strongly. Their earnings results coming through really well. The other sector that's also leading very impressively is consumer discretionary. And again, consumer discretionary doesn't really tend to do well in an inflationary environment. So those two are sector leaders. That's what the market is saying. It's saying that they're not concerned about the growth sectors continuing to march higher. So that's a little surprising in an inflationary environment. What isn't surprising is the materials and energy are also leading sectors as well, and that's pretty normal with inflation. So just a few surprise things there. But look, the bottom line is, don't overanalyze it. Don't try to outthink the market. Just go with what is. Technology's doing well, consumer discretionary is doing well, etc. So just do that. You just got to keep it simple. All right, let's turn to American stocks. The S&P rose just over 1% for the week. Earnings season wrapped up, and it was strong from start to finish, with one of the highest rates of earnings beats in excess of 80% that we've seen, and also the forward guidance for companies, highly encouraging, and I've made note of this many times, but when stock prices are going up strongly, there is absolutely no need for company CEOs to go out on a limb and raise forward guidance. They just don't need to. And the way the game is played in America is that you under-promise and over-deliver, and everybody's happy. So the fact that so many CEOs are raising guidance shows that they must have an extraordinarily high level of confidence about what is coming. So I always find that a really strong point. Now the US dollar continues to move higher. Seems only a couple of weeks ago we were talking about resistance at 94.7. Now we're over 96. 10-year yield steady from last week. The VIX did kick up a little bit, but that could be around options expiry, which was on Friday. So let's jump in and have a look at some charts. And we'll start with the spread chart. So this is the Russell 1000 growth versus value ratio, so tends more to the large cap end of the market, and you can see it's just rising really strongly since June. So we've had 5 months now of significant outperformance by growth stocks, so you can't really argue with that chart at all. This is coming down into the smaller caps. This is small cap growth versus small cap value, and both that seems to be in equilibrium. Line going sideways means that neither one part of the market is favoured over the other. And there's another chart I'll show you in a minute of the mid caps, and we'll look at the small cap Russell as well. That really indicates that money is flowing into both sectors. And this is consumer discretionary, so this is a really important one. Now, okay, this is skewed a bit by the performance of some mega cap stocks, but nevertheless, consumer discretionary is absolutely killing consumer staples, and that's the sign of a very buoyant and very confident stock market. Now, just a couple of other charts that I wanted to show you. So this is a key one for me. This is MDY, which is the mid-cap 400 ETF. So this excludes the impact of the Apples and the Amazons and Netflix and Tesla and all those stocks. And you can see we've broken to new highs. We're just doing a little consolidation here, which is fine. But clearly this is still a very bullish trend, and that indicates that the American market advance is quite broad-based. 200-day moving average still heading up. Then we've got the 50, and then we've got the 20. They're all stacked up nicely, and the price is above all of them. So, it's about as strong a broad-based index advance as you'd want to see. A couple of other industry groups that are really important. This is semiconductors. Despite the supply chain issues, semiconductors doing amazingly well. Nvidia is contributing to that to a significant degree, and their earnings the other day were really strong. An outstanding result for Nvidia. So semiconductors continue to do well, and I think they'll continue to do well for the rest of this decade, albeit with some corrections along the way, of course. Now this is uranium. So uranium cooled off a bit last week. You can see we were down 4 days out of 5, but uranium's still advancing. Just, take the bigger picture. There's the 200-day moving average is heading up very strongly. In fact, if anything, it's starting to accelerate. The 50 is still rising quite strongly. So's the 20. We're getting a short-term pullback, but that's normal and in fact desirable. This is the LIT. This is the Global Lithium Index, and you can see it's continued to advance really nicely as well. This is energy. Energy took a bit of a downward step on Friday. I'll talk about that when we get to the other commodities slide, but it's still a very strong advance if you look at the direction of the 200-day moving average. So that is looking particularly strong. Okay. So if we now look at the S&P, You can see that we've still got a very nice advance here. I tend to look a bit less and less at the S&P because it does get swamped by the performance of the mega cap stocks, and so I don't, I would much rather see an MDY rising strongly, for instance, or the consumer discretionary ratio against staples rising strongly than what the S&P is doing. But there it is for the record. And if we look at the Russell 2000 for small caps, so we saw the growth versus value for small caps. We had a breakout in the Russell. We've now had a bit of a pullback. But look, that's just normal. We're now retesting the breakout, and we're around options expiry. We might still be a little bit wobbly for a few days next week, but clearly small caps are still doing pretty well. So we're in pretty broad-based territory here. And there's the Nasdaq, of course, with so many of the really major tech stocks doing well. You'd expect the Nasdaq to be looking like that. Turning now to the US dollar, you can see clearly in breakout mode now. And I guess the next upside target, we're going to have probably a bit of resistance around the high 97s, but then we're back to basically 100 on the dollar index. And of course that's got consequences for equities, it's got consequences for all the other currencies, and also for commodities as well. So it's going to be very interesting to see if US dollar strength remains, what happens with commodities like copper and nickel that have got a tremendous supply-demand story, but they've got the downward pressure of the currency impact. So that's going to be a very interesting situation to watch. And the effect on the Australian dollar was to push the Aussie down to 71.81 at the close. And if we pan back and take a bigger picture look of the Aussie, so during the crash of COVID last year in February, March, we got down to 57. So we're sitting at 71, so we're still miles above that. But if you look at where the next resistance level is, there'll be, the next support level, we will have some support around 70.72. And then there'll be probably some more technical support come in just a little bit lower around 69.7. So that's the area that we're sort of hunting for on the Australian dollar, somewhere between 70 and the low 71s look to be where we're going at the moment. So Aussie stocks 71.8, as I said. Our index fell 0.7% for the week. And really the ASX 200, to my mind, is really a set of major sectors just going nowhere. If you take a bigger picture view, if you look at all the sectors, there's not really much of a trend going on there. All the action is very specific under the hood. It's in the mega trend themes, particularly battery materials, but there certainly are others as well. So that's really the fishing hole that you want to go looking in. And I think most really big cap stocks that aren't innovators, that aren't disruptors in some way, need to be looked at with a degree of skepticism. Because if you're not innovating and you're not disrupting, then someone's going to come and get you. So just be very careful. Don't just go with conventional thinking with Australian top 200 stocks. You really want to make sure that anything that you buy is either in one of the mega trends or it's a real cutting edge innovator in its own right. Precious metals, gold fell $19 to $18.69, and of course under the impact of the higher US dollar. So inflation fears are pushing the US dollar higher, and also the differential with Germany. There's a very strong correlation between the bond yields in America and the bond yields in Germany. And when when the bond yields in America are outperforming Germany, then it tends to push the US dollar higher, which is what you'd expect because of currency flows. So inflation pushing the US dollar up, that's keeping some downward pressure on gold. But if you strip out the currency effect, gold is going up. There's no question about that if at an even currency. So that's a battle that's going to continue to wax and wane in the next 12 months, I'm sure. But again, logically, you would expect gold will do well in an inflationary environment with this much debt and this much stimulus. It hasn't done as well as some people would have predicted, but just remain open-minded on gold. Now, if we turn to precious metal stocks, GDXJ, as we'll have a look in a minute, has backed off key resistance, but that's really just in relation to what we saw on Friday. So let's just have a quick look at gold. So there's gold on a weekly. We managed to break out of the downtrending channel. It was buoyant at the start of the week, but you can see finished on its lows. We're still in breakout mode though. We broke above these tops. We broke out of the channel. So there is some positive action there. And if we look at it on a daily chart, you can see. So gold was still going along quite well until Friday. Silver, looking somewhat similar, performing pretty much in line with gold. And we'll look at GDXJ because whilst it's called the junior index, these really are probably more appropriate stocks that most people own rather than the mega stocks like Newmont and Barrick, etc. So you can see GDXJ had run up to fairly important resistance. There's a lot of highs and lows around this level. It's backed off a bit, but that's normal. We are forming higher highs and higher lows, and the path of least resistance for gold stocks is to the upside, it would appear. Other commodities, copper $4.35, nickel $8.95, haven't changed much in the last few weeks. And the real challenge for base metal stocks and battery material stocks is how to provide several multiples of the current supply and to do it sustainably, because so many funding sources now are demanding that any new mines are developed in a sustainable fashion. Unless that changes, and it's really hard to see that changing because of societal pressure, then not only has new supply got to come on, which is a big enough ask in itself, because you just can't switch on mines that are going to move the dial. A whole raft of little producers doesn't move the dial very much on a global scale, not with the sort of huge demand increases that are coming in the future years. So you've got to get big mines and big new discoveries, and it's harder and harder to do that, and it takes longer. And then overlay that, you've got to do it sustainably as well, which means that some operations they're just not going to get funded. So that's the real challenge. Now, there's a couple of other things to consider here. The low-hanging fruit was gone a long time ago. So people have got to look in more difficult places. They've got to look deeper. It all just makes the discovery process that much harder. And if you want to stay more with tier one jurisdictions, it really does make it hard. And also the other unknowns are the battery recycling industry is really just starting to get some real attention and some real momentum. And the question that I don't think anyone knows the answer to at this stage is, how much will recycling of batteries materials impact the supply and demand equation? No one knows the answer to that. There could also be new chemistries and new technologies that come into play in future years as well. So it's not just an incredibly robust outlook. There's a lot of cross currents here, but overall you'd have to say that the supply and demand outlook certainly strongly favours increasing prices. But in the short to medium term, the US dollar is rising, and so that's going to keep a lid on those metals prices. But overall, you'd have to look through to 2030 and conclude that it's going to be a pretty good environment. Now, crude oil was steady at 80.85, didn't change much. That's why the move down in the XLE on Friday night was interesting. It rolled over quite sharply on elevated volume. Now, whether that was just one particular stock or not that influenced that, I don't know. There's the spot copper chart, so not a lot of change there on the week, despite the US dollar moving higher, and the same for nickel. So take out the currency and these metals prices are still moving higher. So to wrap it up, a subject that is near and dear to my heart. It's just so critical. In fact, it's really the only critical thing that you've got to do, and that's get clarity around your purpose and your game plan. And just to touch on some things that I've mentioned before, you've got to have a big list of stocks, the type of stocks that suit you. There's no point in wanting to buy 10 stocks and only having 10 choices, because inevitably you will find a reason to pay too much for a stock that's rising. So you need to have a big list. If you want to buy 10 stocks, then have a list of 40 or 50 to choose from, and then just buy at your terms. So have a rough idea of the entry level, or a rough idea of what a good pattern looks like. And if you've got those two things, then you just be patient and just keep it really simple. You know, this is not rocket science. It's about a mental challenge, is what successful investing and trading is about. And it all starts with clarity of purpose. And unless you've sat down and you've thought it through, what are the sort of stocks that fit your requirements, your personality, your lifestyle, then there's no point in thinking about any stock, to be honest, because you're just making decisions in isolation. And finally, just shut out the noise. There's so much noise out there. It's easy to get diverted. It's easy to seize on what would appear to be a very logical argument that's predicting some doom and gloom. You just got to shut all that out and ignore it. Portfolio analyst last week, we looked at a very interesting subject, and that's the process of using scans, both technical and fundamental, to give you ideas or answers, versus the more difficult, or not difficult, the more onerous process of just building a big list. You know, it takes more time. You don't get an instant answer. It's a bit harder to do, but list building, in my opinion, delivers, and in my experience, delivers far, far superior results to just doing a scan and getting an answer. There was also the review of the 10 bag of stocks that had been sold, just to look at it from the point of view, well, what happened to the price after we got out? And 90% of the multi-bagger stocks that we've got out of have subsequently, that first of all, they were in profit, and secondly, the prices have subsequently fallen further. So exiting when we did was actually a good plan. So that was Portfolio Analyst last week. There is more information on the website, and there's my email address for anyone that wants to contact me. That's it for this week. I'll be back with you next Sunday. Cheers.